So what will be the London property crisis of 2015? Well, I think in the first instance, we need to look at the macro picture. We're living in a time of huge political interference. We're all aware of that. The problem is that politicians and central bankers are, they feel they need to be seen to be doing something. This has been exacerbated by 24-hour news, 24-hour television. So they come up with policies. We all saw what happened with ATED a few years ago. They opened up a can of worms without really understanding what they were doing. And so the policies are leading to unintended consequences, which lead to further policies and further unintended consequences. London property has been affected by this interference probably more than anything else. The biggest interference in recent years has been quantitative easing, which was supposed to theoretically get companies back on their feet and increase employment, which arguably it has done, but by far the biggest effect that QE has had has been to boost asset prices. Now that has benefited London probably more so than anywhere else, because the city's doing incredibly well because of the security factor that people put in London. Asset prices in general have gone up, and London property has been the big beneficiary. But people always talk about house prices. That's misleading. What they should be talking about is land values. Because, as an example, if you buy a house for, say, 13 million in Belgravia, and the house burns down, the rebuild cost of that house will probably be between 1.5 and 2 million. So the land is worth 11.5 million. I used to own a house, this is how grand I am, not a house in Belgravia, but a house in Sunderland, which I bought as an investment. That house cost me £25,000 to buy. The rebuild cost was £80,000. So the land has negative value in somewhere like Sunderland, which is absurd. But actually, the reason why London benefits so much is the huge infrastructure that we have. Now, I know this sounds very obvious, but it's absolutely key when you look at property. We have, it started with the Thames, and then over the centuries, roads, the underground, trains in. We've now got Crossrail and HS2 coming in as well. And obviously, we've got the Channel Tunnel bringing into King's Cross. That brings more business in, and it becomes a self-fulfilling circle, which is why London is now arguably the global city in the world. And if you look at all the money that's coming in from Singapore, China, Norwegian pension funds, or sovereign wealth funds, Canadian pension funds, there is a huge underlying positive effect for London, which I think will continue. So although this is about the crisis of 2015-2016, I'm actually quite bullish on London property as a whole. Whereas places like Sunderland, unfortunately, there is absolutely no incentive for the private sector to build. In fact, they can't build there. The only way they can build is through subsidies, either direct or indirect through some infrastructure spending, which we're not seeing. And I think this will actually lead to huge social unrest in around 2025 and 2026. But that's a story for another day. So let's look at London, what's happening here. Now, the big talking point of late has obviously been the changes to stamp duty, land tax. When it came out at the time, it was actually a genuine shock. Normally, you know what's going to happen in the statements, but that was a genuine shock. My view was that it would be subsumed by the market fairly quickly, and we're already seeing that to a degree. Prices have definitely come down because sellers have realised they're going to have to accept the costs, and the sellers who haven't have just withdrawn their properties from the market. But if you look at the transaction prices, they're down 5 to 10% in some areas. There are some people selling who will take bigger percentage hits than the increase in stamp duty, especially the international owners who all they see on television is mansion tax, stamp duty, we don't like international buyers. But this is magnified out of all proportion by the press. The example I always give is SARS. When SARS happened, or was first the major news story, it was Singapore as the epicenter. We're all going to die of SARS in about 2 or 3 years. And I had a godson in Singapore, so I phoned up my friend and said, "Oh, you all right?" They said, "Well, what are you talking about?" I said, "SARS, we're all dying. You're dying first." They literally didn't know what I was talking about. They said, yeah, people wander around the streets wearing masks because of the pollution, but also it's a cultural thing, they don't want to give colds to other people. But the UK press, it was the centre, it was the hot topic for a week or two. Flip that round with London property, and that's why some international buyers are very, very keen to try and sell now. And we've actually taken advantage of opportunities where people, in my mind, are flapping because of concerns about stamp duty and mansion tax. My own personal view with mansion tax is that I don't think they will bring it in. There's no guarantee, but if you look at what they've said, up to 3 million, it's an extra £3,000 a year, which is probably where council tax should be. Where they're being very clever from a political perspective is they're leaving this uncertainty, which is great for their supporters, because this is right, we're going to bash the rich. Obviously, for anybody with big property or expensive property, you're slightly concerned. But if they win the election, if they win it with the Lib Dems whose idea mansion tax was, have already changed their mind on that. They said, actually, this is a very bad idea. So my view is if they get into power with the Lib Dems, they'll give it as a fob to the Lib Dems. We'll forget mansion tax, we'll go down the council tax route. The mechanism's there to collect council tax anyway, so it's easy. They could get in with the SNP, but ultimately they can't afford to alienate the money. You look at François Hollande, the most unpopular politician in French history, and all his more draconian tax measures are dissolving right now because he's realised that you can't alienate the money. Syriza, another example. 4 weeks ago, were promising all sorts of things, and 80% of what they said they were going to do, they've already given up on. And I think the mansion tax will be a similar scenario. But international buyers are under pressure. Capital gains tax increases, stamp duty increases, the use of offshore funds against mortgages is all making life harder for international buyers. So I don't think this will affect the core London market that badly. And the reason for this is that the core London market, let's get the stats exactly right here. Overseas buyers, this is from Savills, overseas buyers purchasing property as rental investments only account for about 7% of all Greater London residential transactions. The percentage seems much higher due to investor activity in the new build sector, which accounts for less than 10% of all London transactions. So, the big one that everybody's talking about is Battersea Power Station. Yeah, that is 80% plus international buyers, and that's where I see the property crisis of 2015. There is, in my mind, very little margin of safety for international buyers. As I mentioned, capital gains tax, SDLT. But I think there's a significant chance, very high probability of price falls in the high density new build developments. If you look at Battersea Power Station and then the Nine Elms development and that swathe of SW8, there are 16,266 apartments with planning permission, and there's probably going to get planning for about another 4,000. So you've got 20,000 identikit apartments, basically, in a very, very small area. Now, the majority of buyers are from Asia. There are some from the Middle East, but a large percentage are from Asia. And a lot of the Asian buyers have no intention of completing on these properties. They are options trading property. They just want to flip them and get out. The problem with that, though, is who's going to buy them. Because in the contracts, they're only allowed to sign the contracts, i.e. flip them once. Other Asian buyers want to do exactly the same, so there are no Asian buyers. The English buyers, there aren't really any, otherwise they'd be selling them in England in the first place. And the reason for that is actually partly area, but predominantly price. And a lot of Asian buyers who already have these properties are beginning to realise that flipping them is not as easy. The profits look great on paper, but in fact, they're not. And there's already some disquiet from people I know in Hong Kong and Singapore about this. The psychology of these buyers is absolutely extraordinary. I was speaking to an agent one of the big firms they're actually trying to avoid the resales because the prices that the original buyers want flip are just unrealistic. And in fact, one of them got a call the other day from somebody who says, I own a flat at Battersea Power Station. I want to know what it's worth. And she went, great. Which phase? When did you buy it? I bought it yesterday. I mean, what? I bought it yesterday. What's it worth? What you bought it for yesterday? And probably not that much. The second bit she didn't say, but under her breath. So the problem is they think there is a discount because they're buying off plan, which historically there used to be, because you were taking on the risk of potentially the developer going bust and you were helping them with their cash flow. The developers, if you look at the first phase, Battersea Power Station, or let me put it another way. In December, the CEO of Battersea Power Station said, hold on to your investments till 2020, because that's where you'll get the full value profits for your investment. And he said, people have already made 30 or 40%. Well, they have, because the first phase was selling for about £1,200 a square foot. The new phase is £1,700, £1,800 a square foot. So they've just put the prices up. The people haven't really made a natural profit, as it were. So the buyers are now buying at a premium rather than at a discount, which is why they're hoping to sell for another 300,000 or 400,000 on top. They're just not going to get. In addition, you've got a complete lack of knowledge of what they're buying. They haven't looked at the master plan, and if any of you have looked at the master plan, you probably haven't because you've got lives, but if you live my life, it's shocking. The closest, they're 17 stories high, so it's where the towers start is as high as they go. But you've got very few river views, bizarrely, but you do have views of the largest brick wall in Europe, which actually isn't that great. Some of the buildings at the closest point are only 18 metres apart. They've crammed a hell of a lot into this space. And it's going to be a building site for another 10 years. The first lot of apartments completed in 2016, a lot of buyers don't even realise that the tube station won't open until 2020. So who on earth is going to rent those between 2016 and 2020? Because you can't get to Chelsea Bridge without walking the whole way around, because they haven't knocked through and underneath yet. And that probably won't happen for another 2 or 3 years either. So you're going to have a whole lot of properties coming onto the market, obviously not all 20,000, but a huge number. There are already 100 one-bedroom properties available for resale now. They're not going to be able to sell them. They're not going to be able to rent out most of them. So there will be people the options trading people who just won't be able to complete. You've got the people who've done the figures, theoretically, who won't be able to get the rent because there'll be too many identical properties. They're being told they'll get 4%. So a one-bed, £1 million, £40,000. You've got to earn an awful lot of money to rent somewhere for £40,000. And there are 20,000 of these eventually. I mean, I just can't see how they're going to do. Sorry, how am I doing for time? So that in a nutshell is where I think the problem is going to be. And I think you will see a lot of distressed sales towards the end of this year in 2016. So if you're planning to buy there, I wouldn't. I would hold off. I will wrap up very quickly with one other thought. The big issue is also, because of the predominance of Asian buyers, I believe there's going to be quite a big property crash in Asia in the next year or so. The reason for this is that there is an historically proven property cycle of it's actually 18.6 years. In the UK, you can take it back to the dissolution of the monasteries, and it is literally like clockwork. The only two times it's failed is during the 2 world wars. Same in Australia, same in America. The last Asian property crash was 1998. You probably will remember the Asian tigers and so on. The precursor to a property crash are huge hikes in land values. They normally happen a couple of years before property prices hit their peaks. So land prices, this is from Knight Frank, land prices between December 2011 and December 2013 rose in Bangkok by 190.7%, Jakarta by 184%, Kuala Lumpur by 67.2%, and Beijing by 37%. So if that market wobbles, the Asian buyers will stop because they'll be taking such big hits at home. Now, look, I can't guarantee any of this, but the probability of there being massive issues in the Battersea Power Station come 2016, very, very high. Whereas the opportunity to pick up bargains could be very, very good. So I would just hold off for a couple of years. And that's the advice that I've been giving my clients for a couple of years now. As I say, core central London I think will actually be fine because there's so much money coming in from all over the world. So it's not as concentrated. And so that's my thoughts on the property crisis of 2015. Having said that, you do want to look out for changes in policies. So if India and China were to relax their exchange rules, then new build properties are exactly where you want to be because they'll just be a wall of money. They literally buy photos, they're not interested in anything. And to show you how the Chinese will get their money out of China, I'll hand over to Simon, who's got some quite interesting things to say on that front.
Jeremy said at the start, location, trends, buying conditions, and making a good start, but this can be washed away without the right strategy. Currently, this country faces the world's worst inheritance tax level. It is worse than the United States of America. Inheritance tax starts at £325,000 on the death of the surviving spouse. It is the highest inheritance tax rate taken into the thresholds. I've not really seen anything that competes with that. So 40% of your estate can be lost if planning on that arrangement isn't taken into account. Capital gains tax, 28%. From April of this year, capital gains tax is extending now to non-resident individuals and non-resident companies. Income tax on rental income can quickly rise to 45%, and you've got this dreaded annual tax on envelope dwellings, the ATED, which some people confuse as a mansion tax charge. It's an annual charge which has had a 50% increase from when the annual charges came into account legislated for in 2012, and which became payable in 2013. The highest annual charge comes in at £218,200. When you think of keeping a property owned by a company without an exemption, in 10 years you can be paying over £2 million in taxation. Getting the planning wrong can dissolve your investment quite quickly, and reverting into sort of negative gains, an oxymoron. But getting it wrong, not getting in the right structure, can compound those figures. So I turn you to page 2, because this is not a tax lecture. It's to assist you to navigate through the corridors of certainty in how to use arrangements to overcome inheritance tax. That's the easiest one for non-UK domiciled persons, people that are not British, people that have not picked up a deemed UK domicile and lived here for 17 years out of 20. That is actually the easiest one to navigate away from. None of what I'm suggesting is aggressive, not aggressive tax avoidance, not subject to general anti-abuse and DOTAS disclosure of tax avoidance schemes. It's soft, it's reliable, all of these arrangements have come with a council's positive ruling, and the council of barristers, or the chamber of barristers that have given this ruling, are amongst the ones that have written the GAR legislation, the general anti-abuse regulation. So all of this is within the spirit and acceptance of legislation, and is also perceived to be 2015 Finance Act compliant. So no scheming, no quick, fast tricks, only to benefit the intermediary. So you've got to really look at ways of making sure inheritance tax never applies, especially for foreign purchasers, to perhaps protect against that capital gains tax regime, which is now going to be extended to non-resident individuals and non-resident companies. Income tax, well, that's quite easy to reduce in terms of rental income, and the ATED is the nasty one, the annual tax charge, which no one really wants to suffer. So on your grid, ladies and gentlemen, you've got investment type, even from the bottom, commercial UK property into UK main residence. The status of the investor, this is just a reference document, status of the investor There's the non-domiciled types, the overseas investor, the foreign purchaser, whether he or she lives here or not. The tax rate and advantages, which really are the benefits. And over to this level here, this section here, that's for UK domiciled persons. So we don't frighten our way away from dealing with US persons or British passport citizens and residents. There's structures for everybody. And I'd say that UK main residence for a UK domiciled person like myself, buy it in their own name, get a mortgage, have a mortgage if possible, life insurance to negate the inheritance tax possibility and a goodwill. On non-domiciled persons that are not going to rent out their property, use a trust or a double trust. Stamp duty normal rates, no inheritance tax, no ATED charges, no shadow directorship charges. Don't touch companies on non-buy-to-let properties. Buy-to-let, it's been simplified. Buy-to-let, property investment, property that you're not going to occupy yourselves, very, very straightforward. The legislation's become clearer over time. And there's nothing wrong with a British or a non-British person with a buy-to-let exemption buying in an offshore company name. You could still easily get a mortgage of 65+%. Claim one of the exemptions. That's the development exemption if you're developing, or the letting exemption if you're letting. It's a straightforward procedure for a trust company. No, the 15% stamp duty charge on companies, non-natural persons, does not apply if it's a buy-to-let investment. So is it for the foreign purchaser to occupy and enjoy, or is it a buy-to-let, a property that's going to be rented to third parties? On that basis, easy. Use an Isle of Man or a BVI company, stamp duty normal rates, no ATED, exemption applied for, and net rental income is only taxed at 20%. Okay? So this media hype that Jeremy referred to in his opening talk, don't believe the media, don't believe what you hear or what you see, get some proper advice. Buy-to-let investments has never been easier through an offshore entity, even if the beneficial owner's British domiciled or even non-UK domiciled. Non-UK main residence again, trusts, so anything that's not going to be let out commercially or to third parties, trusts. For UK DOMs, it's probably personal ownership. Moving down to property development, this is the trading area of property, and I know some of you are involved with this. The sourcing of real estate, the developing of the real estate, the marketing of that real estate, and the selling of that real estate. No investment element, please, no rental income. Isle of Man companies. Isle of Man companies, because of the tax treaty and permanent establishment rules, will not be subject to UK corporation tax on trading gains. So if Jeremy finds a development for you, 5 million, you're going to put 2.5 million into the development of it, and you're going to 7.5 million in total, and you're going to sell for 12.5 million on the basis these units are going to be sourced, purchased, developed and sold, no corporation tax. The taxing rights are, under the treaty, are visited in the name of the Isle of Man company, so you avoid the 20% corporation tax in the UK. Commercial property, no government has dabbled or messed or brought in draconian measures to collect more tax on commercial property. We need commercial property investors. HMRC get their 20% tax on net rental income. Commercial investors are very, very much welcomed. At the moment, they seem to be coming from the Middle East, from a non-dom point of view, Middle East and Singapore. That's both development and commercial UK property. And very, very easy to purchase a mixed-use property or a commercial building anywhere in the United Kingdom through an Isle of Man company. 4% stamp duty. You've got the benefits. You've got the benefits in the column there. No capital gains tax, no inheritance tax, no ATED, low rate stamp duty. Nothing has been touched or in terms of troubling a commercial UK property investor. So whether your client is UK domiciled or non-UK domiciled, on the basis you can inform us, and inform us both, of the nationality. That's important just in case they're US nationals, because there's FACTA compliance to contend with, and we're both US friendly in terms of helping US persons to invest in UK property. Sovereign is a foreign institution as confirmed in the FACTA regulation, so we can deal very easily with US persons. They've just got to be aware of their reporting requirements. So nationality or citizenship, they're domiciled, are they domiciled or not? Where they're living in which part of the world, where they're habitually resident, are they resident in the UK or resident in Asia or in other countries? And where the investment monies, investment funds are held. Now that may be in Hong Kong, it may be in Singapore, or it may be just with Barclays Bank, Leicestershire. We've got to know that, because that gives us the constituent components to assemble a plan and a routing to enable these clients to avoid 40% inheritance tax, to defer at least capital gains, to reduce income tax on rental income from 45% down to 20%, and to get rid of that nasty ATED charge. So that compounds the benefits that Jeremy will bring to the table in terms of Mercury Home Search can offer, and matched with a strategy. All we need to know is citizenship, domicile, nationality, residence, and where the funds are, or whether a mortgage is required, to then lay the foundations for a plan that will be 2015 Finance Act compliant, won't be scheming, and will stand the test of time. And that guide, as opposed to reading lots of legal opinions, gives you a good route to go. As Jeremy mentioned earlier, that's the stamp duty and ATED current arrangement. So new rates of stamp duty on the left. That all changed. It all changed on the autumn statement. So that's the new rates. Up to 925,000, you are better off. Over 925,000, you're a lot worse off. Graduated SDLT coming into effect autumn statement day, midnight. No negotiation. That's that ATED band currently. So ATED wasn't so bad this year and before, and the projected ATED rates coming into effect the 1st of April, horrible big increases. And that's on the basis that you have a company owning property that is not able to claim for one of the exemptions, and a buy-to-let exemption at that. So use that as a reference guide. But if you make the mistake of buying a property for a company and not claiming exemption, not subject to any rental to third parties, you'll have that 50% stamp duty in the ATED rate. Not very pleasant at all. Solutions, where we look at the demographics of a property purchaser. He's non-UK domiciled. His sole interest is to buy a property or properties for the requirement to buy to let. They're not going to enjoy the property. None of the family are going to live in the property. They're going to rent for a minimum of 3 years, if not more, and they want to plan around those horrible tax charges that I talked about earlier. So starting with SDLT, not 15%, because it's a buy-to-let and letting exemption is claimed, so it's a regular stamp duty. There's no ATED because of the letting exemption, so you don't have any of that ATED charge, which everyone thought always applies to companies. There's no inheritance tax because it's not an arrangement which is UK controlled, UK registered. It's owned by an offshore company, so that's easier than an easy option then, rather than having the property purchased in one's own name. And there's a shelter from CGT which extends from April for these non-resident purchasers. If you have an offshore life bond or an offshore insurance policy sitting between the company and the trust, or the company and the beneficial owner, or his particular arrangement, capital gains tax will not apply under the proposed Finance Act or Finance Bill 2015. So those are the salient benefits. Buy-to-let property owned by a company, 20% tax on net rental income, not 45%. It's not that bad, is it? But distinguish, don't have the property rented for 6 months, it's unoccupied for 2 months, and park the beneficial owner's son there for a while, as he or she is in university, you lose all the exemptions. You'd have to pay the high rate stamp duty, you would be exposed to annual tax and envelope dwellings, and a whole load of reporting consequences which are quite vile. So buy-to-let or personal use, separate the distinction. Moving off to number 5, which is a little bit of a, which is colourful, which is a busy slide, and this is on the basis that there's not going to be a buy-to-let investment. It's a property that is going to be purchased by a non-UK domiciled foreign person. The foreign person may already live here, the non-dom may already live here, the non-dom may become resident in the future, the non-dom may periodically wish to use the property when he or she frequents to London, or it may be a future home for the children when they live here, work here, go to university here. Don't use a company. Use a company, 15% stamp duty, high rates of ATED, shadow directorship charges, and you will regret the consequences of corporate ownership. Use a trust, a non-dom settling a trust for the benefit of their family, even if they're already here. Low rate stamp duty, no ATED, no inheritance tax. So you've avoided the worst possible tax in the world. No shadow directorship and and benefit in kind tax charges. It's a trust. A trust is not an NNP. It's not a non-natural person. And if you use a trust to buy the property, and the proceeds are, please, the proceeds are used or loaned in from the outset, the debt outstanding is assigned to a debt trust, so there's a double trust situation here, then there's major benefits accruing to this sort of arrangement, especially if the property is multi-million pounds of value. So you avoid the 10-year anniversary charge for those lawyers in the room that are worried about the 10-year anniversary charge. Inheritance tax is covered off. There's no ATED because it's a trust. And there's no shadow directorship charges and all of that. Certainly no 10-yearly anniversary charges. And if a trust beneficiary can look to occupy the property pre-sale on a 3-month, 90-night basis, probably the previous tax year and the current tax year when the property is sold, don't forget, capital gains tax will be extended to non-resident individuals, non-resident companies. Main residence relief can be enjoyed, rather like claiming main residence relief for a person living in their primary place of residence. So capital gains tax can be avoided going forward. So trusts can be used for avoidance of capital gains tax, certainly the legal avoidance of inheritance tax. It's not a buy-to-let property, and the major benefits accrue. And even on the saving of ATED, this sort of arrangement might only be £10,000 a year to maintain on a more expensive property versus the consequences of ATED, the consequences of inheritance tax, higher rate stamp duty. This is not necessarily for the rich and famous. The threshold of a property purchase for that arrangement is probably £5 million upwards to compensate for a double trust structure to have all of those benefits. Again, Jeremy and I will send the slides around to you as reference. Victor, Roberta, and myself are here to discuss matters, if you want, on a one-to-one basis. Jeremy, obviously, and I will stay on for a lot longer. And so, characterising the event, a non-buy-to-let situation, a non-dom situation, who wants to avoid those salient charges that I have looked at before. UK DOMs, UK domiciled individuals. They don't have to be non-resident. This could apply to non-DOMs long-term residents or non-DOMs that have acquired a domicile of choice, those not returning to their former land, and very easy. Property is going to be let. Property is going to be rented through an agency not being used by the friends and family. Get a normal company. Isle of Man, BVI are the user-friendly companies that can acquire mortgage finance very, very easily. Banks like to lend against companies. 20% income tax on that net rental income. Letting exemption acquired. Normal rates of stamp duty apply, not 15%. No inheritance tax, I'll tell you why in a minute, and a shelter from UK capital gains tax. The person is more UK than the slide before. They may be UK domiciled. They may be UK domiciled, UK resident. They may be UK domiciled and currently living overseas and coming back later on. And if they have the shares owned by a Guernsey qualifying non-UK pension scheme, pension schemes, pension arrangements were successfully legislated by Parliament in 2010, qualifying non-UK pension schemes, which give shelter from inheritance tax. That's what they were designed for. Parliament legislated for this. This is not a scheme. And they give shelter from UK capital gains tax. So a British person, Mr. and Mrs. semi or totally successful, can use that arrangement to avoid ATED, to avoid IHT, to avoid, I don't want to use the word avoid aggressively, but Parliament has legislated for these arrangements a number of years ago, and they're not about to change them for the worst. And opinions have been granted which verify that these arrangements do generally work. Case by case, but we had tried and tested experience, so has Jeremy. Running out of time. I'll leave this one with you because dealing with brand new clients or brand new investment situations, as Jeremy will probably agree with me, is much easier than dealing with a pre-existing problem. A problem meaning, oh, I bought a property, it's in my own name, or, oh gosh, it's in a company name now. It worked pre-2008. It was sailing along swimmingly well, like all my friends in Saudi, Kuwait, France, Spain, and everywhere else. But now it no longer is very good because I've got an offshore company which has purchased a property for 7 million, high values of ATED, capital gains tax applies if I want to sell. Do I liquidate to myself? I really regret getting involved with this in the first place. Can you please help? Properties that are over £2 million in London, the vast majority were purchased by non-UK domiciled persons. A lot of them are not let, as Jeremy's just confirmed, and they're latent with massive problems. ATED charges, future CGT, with the benefit of no inheritance tax applying, especially in the UK. So let's go through a de-enveloping situation. Today's value may be modestly 8 million, so there's £1 million gain to look at there. We want to have the property go from the company route, which is no longer viable because the property is not rented out, through to the trust because it's not rented out. The client wants to avoid STLT on the transfer. They want to avoid that horrible rising annual charge, and they want to have a CGT relief when they sell in the future, notwithstanding the IHT benefits. So set up the trust goes on top of the company, trust owns the company, and the directors of the company with the beneficial owner's consent liquidate the company, so the property then goes to its mother. End result, the property is de-enveloped to the trust. No stamp duty because no debt is outstanding in this case. There was no debt in the first place. No future ATED because ATED doesn't apply to trusts. No 10-yearly charge because there's a new trust with a debt outstanding under a deeply discounted security deed. And in the future, Boris and his growing up family may decide to live in that property for 90 nights a year. And at the time of sale, they can claim main residence relief, and the 28% capital gains tax is washed away on sale. No problem. Also, the property is rebased. The difficult pill to swallow, it was bought for 7 million. It's now worth 8 million. Use your own examples. So the de-enveloping difference is 1 million. So you've got to pay up capital gains tax of 28% on the two differences. But the quicker you do this before the property gets too valuable, the softer the hit going forward. So de-enveloping, it's still possible to deal with existing clients that have lazily or because of uncertainty not dealt with their affairs accordingly. More difficult to deal with, don't wait too long, we can still help them. UK property development, this is more attractive than perhaps people make out. Very often a property development is looked at if there's modest gains and modest exits, use a UK company. 20% corporation tax, it's the second lowest corporation tax in the G7. If the gains are a little bit more handsome, some of Jeremy's client cases, very, very easy to use an Isle of Man company. Isle of Man has a tax treaty with the UK. Isle of Man has attractive permanent establishment laws. This is tried and tested. This comes with a council's opinion on the basis that the property development, not one property unit, is rented out. You source the property, the Isle of Man company buys the property is built or the land is built, property units are constructed on the basis that all of those units are sold. Don't rent them out. It's got to be a trading profit, a trading gain. Under the Isle of Man UK tax treaty, this is not scientific, the taxing rights under the treaty are allocated to the Isle of Man, not the UK where the trade takes place. It's no fault of the UK or Isle of Man government that Isle of Man companies pay zero tax. So the trading company gains are not exposed to 20% corporation tax, they're exposed to zero. If they're non-dom, you can have a trust on top. If they're UK dom, they can have an offshore life bond or a QNUPS. This is not for the rich and famous, this is for the higher hanging fruit, UK doms, or the slightly lower hanging fruit, non-UK doms. Don't rent the property out, buy the land, develop the property with an intention to selling all the units. Don't let one property go off to the friends and family and mix it up in terms of gifts and goodwill and reservations of benefit. You're avoiding corporation tax at 20%. Last one, UK commercial property, the easiest thing to use, the easiest investment to advise on. Non-residential, commercial property, VAT registered within 2 weeks. Beat that in the UK, they can't. Transfer of a going concern, SDLT stamp duty 4%, net rental income taxed at 20%, not 45%. No ATED, it's commercial property. No capital gains tax, it's not residential. No inheritance tax. Commercial property is one of the visions for the future because the government needs it. And Sovereign and Jeremy can do everything that we've so far discussed today. The arrangements mirror Jeremy's expertise and his ability to source for advisors and investors the relevant UK property, and with the strategies and the solutions that Victor and I deal with work very nicely hand in hand.